Can the stock market be predicted? This is the ultimate question that keeps Wall Street buzzing and investors dreaming. Every day, millions search for an edge, an answer. But if beating the market were easy, wouldn't we all be rich? Some say it's a puzzle to solve. Others believe it's just a coin flip. So can you really beat the market, or are we all just guessing? The random walk theory asks, is the stock market a series of random steps or a calculated dance? Imagine a drunkard's walk, each step unpredictable. As in that's all how some experts like Karl, Pearson and Burton Malkiel describe the market. Malkiel even claimed a blindfolded monkey could pick stocks as well as the pros. But what if the real secret is finding great companies, not predicting every market move? Join us as we explore this journey from chaos to clarity. Let's travel back in time to the early 20th century. Forget stock tickers for a moment. Instead, picture a scientist, the brilliant statistician Karl Pearson. He wasn't thinking about stock prices or Wall Street fortunes. He was grappling with a fundamental question of movement and probability. To explain his idea, he painted a vivid picture that has endured for over a century. Imagine, he said, a man stumbling out of a pub late at night. He is thoroughly intoxicated. He takes a step, then another, then another. The question is, where will his 10th step take him, or his 100th? It's impossible to know. His path is a pure random walk. Each step our drunkard takes is an independent event. It is untethered from the step that came before it. He doesn't remember if he just lurched left, so he has no reason to correct by lurching right. He simply stumbles, his direction and the length of his stride dictated by pure chance. This simple, almost comical analogy was a breakthrough. Pearson gave us a way to visualize and mathematically model a process that has no memory and no predictable pattern. He demonstrated that even from a simple set of random actions, a complex and unpredictable path could emerge. This wasn't about finance, it was about the pure mathematics of chaos. This concept, the drunkard's walk, laid the groundwork for understanding randomness in countless fields, from physics to biology, but its most explosive application was yet to come. The idea sat there, a powerful tool of statistics, waiting for someone to connect the dots between the drunkard's strange journey and the chaotic dance of financial markets. For decades, investors and analysts operated under the assumption that the market had patterns. They believed that by studying the past, they could unlock the future. They drew lines on charts. They built complex models, all in the service of predicting that next crucial step. But what if the market had no memory? What if each day's price change was as independent as each of the drunkard's stumbles? This was the radical thought that began to percolate. If true, it would mean that all the chart reading, all the trend following, all the sophisticated attempts to predict short-term movements were fundamentally flawed. It would suggest that the market wasn't a calculated dance that could be learned, but an endless series of random steps. The stage was set for a major intellectual showdown, and the simple story of a drunkard was about to become the most controversial idea on Wall Street. Decades after Pearson's thought experiment, economist Burton Malkiel shook Wall Street with a radical idea. Stock prices follow a random walk. In his book, A Random Walk Down Wall Street, he argued that past price movements can't predict the future. All the ups and downs are just random fluctuations. Malkiel famously claimed a blindfolded monkey could pick stocks as well as the experts. In the end, we're all just taking a walk in the dark, never knowing where the next step will land. At a crossroads, the random walk theory warns us that predicting short-term market moves is futile, like guessing a drunkard's next step. But what if we shift our focus from price to the value of the business behind it? Instead of speculating, we become investors, buying into real companies, not just numbers. By focusing on fundamentals, we play a different game, one of value, quality, and long-term potential. Next, we'll reveal the 9 key metrics that matter most. If we accept that we cannot predict the market's mood, we must find a more reliable anchor. That anchor is the underlying value of a business. But how do we measure that value? We do it by looking past the stock price and digging into the company's core. We need a systematic way to evaluate its performance, its stability, and its potential for future growth. This is not about finding a secret formula, it's about doing the necessary homework. There are 9 critical metrics that, when used together, can provide a powerful, multi-dimensional view of a company, helping you to make more informed and confident investment decisions. These are the pillars of sound analysis. First, we will look at the engine of any business revenue growth. Is the company selling more over time? Then we will examine its efficiency and health with profit margin and debt level. Is it actually making money from its sales, and is it financially stable? Next, we must look to the future. We will assess a company's ability to stay relevant and thrive through the lenses of innovation, industry trends, and its competitive positioning. Does it have a vision? Is it riding a wave of change? And can it defend itself from rivals? These metrics help us understand a company's long-term viability and its place in the broader economy. No company runs itself, which brings us to the human element management effectiveness. Who is steering the ship, and are they competent and trustworthy? But even with a great company and great leadership, your actual return depends on what you keep. That's why we will examine the crucial and often overlooked impact of taxes. Finally, we will tie it all together with a classic valuation tool, the price to earnings, or PE ratio. This metric helps us ask the ultimate question. After all this analysis, is the stock currently priced at a level that makes sense? Is it a bargain, or is it dangerously expensive? Together, these 9 metrics form a comprehensive checklist for the serious investor. They move you away from the random walk of the market and toward the deliberate path of business analysis. They are not a guarantee of success. Nothing in investing is. However, they are a powerful defense against pure speculation. They arm you with the knowledge to look at a company and see not just a ticker symbol and a fluctuating price, but a real business with strengths, weaknesses, and a future that you can begin to understand. Let's dive into the first of these crucial metrics. To understand a company's true worth, start with its revenue, the lifeblood of any business. Is it growing year after year? Consistent revenue growth signals strong demand and smart strategy. Take Tesla in 2023, its revenue jumped 19%, reflecting soaring global demand. But remember, a single number isn't the whole story. Ask, is this growth sustainable, and where is it coming from? That's the mark of a savvy investor. When a company's revenue grows, it's key to know if that growth is organic or inorganic. Organic growth comes from selling more, launching new products, or expanding into new markets. Growth from within. Inorganic growth is from mergers and acquisitions, buying other companies to boost sales. Investors value organic growth most as it shows real strength and innovation. The best companies blend both, but organic growth is the true foundation. Revenue is exciting, but sales alone don't guarantee a healthy business. It's like a fast car that leaks oil. Impressive, but not sustainable. Profit margin is the real test. It shows how much money a company keeps after costs. For every dollar of sales, how many cents does the company keep? Net profit margin is the bottom line, what's left after all expenses. Companies like Apple thrive by keeping profit margins high, not just selling more. True strength is growing revenue while maintaining or increasing profit margins. A company may look strong, but too much debt can make it vulnerable. Debt is a double-edged sword. Used wisely, it fuels growth, but too much creates risk. Investors check the debt to equity ratio to see if debt is manageable. Companies with low debt and strong profits are resilient, like a fortress in a storm. Always check a company's debt before investing. A company's future depends on its ability to innovate and adapt. Is it leading the way or just following? Innovation drives long-term growth and shields against obsolescence. Look for evidence, R&D spending, patents, and a history of launching market-defining products. Amazon is a prime example, evolving from a bookstore to a global tech powerhouse through relentless innovation. But innovation alone isn't enough. The industry's direction matters too. Companies in fast-growing sectors like renewable energy benefit from powerful tailwinds. Think NextEra Energy riding the global shift to clean power. Always ask, is the industry expanding or fading? Are there disruptive trends ahead? Invest in companies that innovate and are positioned in rising industries to maximize your odds of long-term success. Innovation and industry growth are vital, but a company must defend its profits, enter the competitive moat, a business's unique edge that keeps rivals at bay. Moats come in many forms. Iconic brands like Coca-Cola, network effects, or high switching costs. Coca-Cola's global brand and unmatched distribution make it nearly untouchable. These advantages create pricing power and sustainable profits. As an investor, always ask, what stops competitors from copying this business? Wide moats mean lasting returns and portfolio stability. Study moats relentlessly. They're the foundation of durable investments. Combine innovation, industry tailwinds, and a strong moat for a complete picture of long-term value. Even the best business needs strong leadership. Assess management's vision, track record, and alignment with shareholders. Nvidia's rise under Jensen Huang shows how visionary leadership transforms potential into reality. Read shareholder letters, listen to calls, and judge if management creates long-term value. Next, consider taxes. They directly impact your returns. Know the difference between short and long-term capital gains and how dividends are taxed. Holding stocks longer often means lower tax rates, boosting your net profit. Tax rules vary by country, so understand your local regulations. Smart investors factor taxes into every decision. True returns are what you keep after taxes, not just what you earn. After analysing the business, leadership and taxes, one question remains. Is the price right? The price to earnings, PE, ratio helps you judge if a stock is a bargain or overpriced. So PE compares the stock price to earnings per share, showing what investors pay for each dollar of profit. Context is key. Compare PE to the company's history, its peers, and its industry. High PE may signal growth expectations or overvaluation. Low PE could mean a bargain or trouble ahead. For example, LVMH is higher PE, reflects luxury growth, while Total Energy's lower PE signals industry caution. No PE is good or bad in isolation, interpret it in context. The PE ratio is your final reality check before investing. A great company at the wrong price is a bad investment. Only buy when quality meets value. Investing isn't about predicting daily market moves. It's about owning great businesses, and the random walk theory teaches us that short-term prices are unpredictable. Instead of guessing, focus on what you can control, business fundamentals. Think like an owner, not a speculator. Tune out the noise and analyze the 9 key pillars of a strong company. This approach turns investing from a gamble into a strategy. Identify excellence, back strong leaders, and buy at the right price. That's how you move from random walks to deliberate, informed steps toward your financial goals. The intelligent investor's path forward is built on patience, research, and perspective. Metrics are tools, not magic. Blend analysis with an understanding of the market's unpredictability. Focus on quality businesses. Stay calm during volatility, and always reassess when facts change. Master the market by refusing to be its victim. Choose your path with discipline and informed judgment.